understanding the technology that powers the money is essential. Knowing the business drivers that inspire how the money is made is crucial. Bridging the gap between the mind of the technologist and the mind of the business is monumental. That is what TBF is all about. Let's start this never-ending conversation. It's time.
Happy Friday. Welcome to another episode of the Tech Behind FinTech. I am excited for today's episode. I'm joined with the CEO of accounting events, Stanley Egbuchulam. Welcome to our show.
Thank you very much, Nnamdi. I'm glad to be here.
So listen, guys, in general, we all heard about the Silicon Valley Bank collapse, Signature Bank to follow, and so forth. So today's topic is, the regional banks in crisis, a closer look at the reasons why. So looking historically, getting answers to, drilling down, like what's going on behind the scenes, why did this happen, and looking at other bank failures over the last 2 decades. Before I go further, I want to read the bio of our guest today. Mr. Egbuchulam is the CEO of Accounting Events and is a results-focused leader in the accounting field with over 20 years of experience. His strong leadership, problem-solving, team-building, and staff development skills allow him to establish, manage, and elevate world-class accounting functions for numerous Fortune 500 and Fortune Global 500 companies. He solidified his accounting expertise early in his career, having worked for Big Four public accounting firms such as PwC and Ernst & Young, where he audited banks, broker-dealers, and mutual funds, in addition to conducting single audits for federal government programs. Mr. Egbuchulam was also an adjunct instructor of accounting at the New York University's School of Continuing and Professional Studies, NYU SCPS, as well as St. Francis College in Brooklyn, New York. Welcome to our show.
Thank you once again.
So, before we get on, look, I'm going to have to give some transparency here. In addition to Mr. Egbuchulam's bio, this guy has been one of the major influences of my life. We are related. So he's been around me since I was 4 years old, influencing my life in various ways. One of the male figures I looked up to growing up. So, sitting here right now across from him, when we're usually talking about other family-related items, but now talking shop is a major honor. And for me, I'm really excited. We used to, when we worked at firms, as I got into my career, we would some of the firms we worked next door to each other. Never in the same firm, but like in Midtown in the same. We would have lunch, and I would take him to Burger Heaven, and we'd get like milkshakes and over lunch numerous of days. So now sitting on this platform is amazing. I'm really excited for this conversation. He's an expert in his field, and we have the Tech Behind FinTech. So we're gonna really drill in. So thank you for being a guest. And before from Facebook, LinkedIn, YouTube, and Twitch, we have also a live stream going from Instagram. If you have any questions, please drop a comment. You can drop a comment on any one of the platforms, and we will see it in the shared platform that we're using, and we will answer your questions and also post it to the video to be part of it. If you're on Instagram, you can go directly to the techbehindfintech.com, where you'll see a live feed to one of our platforms where you can comment as well and be part of the show. So without further ado, let's jump into it. Going back. All right, so the first thing we want to go over real quick before we jump into the main topic on regional banks, just looking at a few weeks, we've been just looking at the industry from a technology side, the different layoffs going on. Hulu, 200 people. I didn't actually know Hulu was located in Beijing as of 3:30. A couple of others, EA, Electronic Arts, 780, 6% of their workforce, going down to some of the Blue Nile, 119, Lucid Motors, 1,300, Rackspace, 275, Indeed, 2,200. So that's a pretty huge number. Before we move on to the main topic, any thoughts on the state of the industry and the amount of layoffs going on? Stanley?
Is that a question for me?
Any thoughts on the layoffs in the industry from that's been happening over the course of the last few months?
I think layoffs have been happening, not necessarily because of the bank crisis involving regional banks. If you check the trend, although from month to month, when there is a monthly job report, it looks positive, but you have to know that certain industries have been letting people go. And I think this is because of the implementation of systems that rely more on AI and taking over jobs from actually human beings. So I don't think that most of the layoffs are necessarily related to the topic we're talking about today.
Matt, that's fair enough. I know that, overall macroeconomic conditions, the application of one of the things that we saw during the pandemic, tons of hiring was going on just because a lot of these technology companies just vamped up and now they're slowing down. So interesting. I mean, every week, like I said, we cover it. But let's move on to the main topic. So I want to really just start jumping into the major thing at hand. We have Silicon Valley Bank. What were some of the main factors that led to the collapse?
Well, in a simple answer, there was a bank run, right? Bank run is when most, if not all, of the depositors go and want to withdraw their money at the same time. And I can tell you that there is no bank, no matter how big the bank is, that can withstand a bank run. So with respect to Silicon Valley Bank, I think a number of factors led to it. The trigger was the fact that they tried to raise capital through equity issuance. And that transaction failed. And then people panicked. Why did it fail? Well, I think it's because they've made some bad investment decisions. Maybe not recently. It may have been there for maybe over several years. They were overly invested in fixed income securities. And these fixed income securities move depending on which way interest rate goes. So if you notice recently, the Fed has been increasing interest rate. That effort is just to curtail the rise in inflation. So if you have a portfolio full of fixed income securities and the interest rate is rising, you know that the more interest rates rise, the more the market value of your portfolio goes down. So that's what happened with SVB. And once the portfolio values went down and there was reason for investors to go and take money, withdraw money from their deposit as opposed to going to borrow at a higher interest rate. So they realized that they did not have enough capital to meet the increased demand. So they had to sell off some of their items, the fixed income investments in their portfolio. And because they had to sell it in a hurry, they sustained a lot of losses. I heard they lost about 1.8 billion. So having lost that affected their equity. So they had to go out to try to raise equity. Once they found out they couldn't do it and it became public, that was a panic. So the customers were no longer very sure that their deposits are safe. So then they rushed to go and withdraw their money. That's where the problem started, if you ask me.
So a couple of questions on that. Number one, right? When we talk about bank deposits, I mean, one of the things, and correct me here, with your expertise, one of the things that I've learned over the last couple of years, where we think those deposits are assets, but to the bank, an actual bank deposit is a liability, right? So,
Yes.
the assets are more so around their products and things of that nature. So, and going back to the questions around treasuries, right? So, they decided to put the money and invest in there. I know some other banks use loans and things like that to generate money on top of their assets. Why do you think Silicon Valley Bank didn't go take that action as opposed to the action of using the treasury aspect?
Every bank has a specialized department that is called that does the asset liability management. Everything has to be balanced and rebalanced. So there's a function within the treasury that it is their responsibility to make sure that there is a balance in the portfolio of investment that the bank hold. So the bank takes in deposits and they're going to loan some of them out, okay? And then they are going to diversify the portfolio by purchasing some treasuries, some short-term and some long-term. And let me tell you, maybe one other thing I should have mentioned was there is also an accounting implication for what happened to SVB. And that is when you invest in fixed income security for the first time, there are certain accounting classification elections you have to make. One is you classify them as trading and you put it there market to market every day, whatever gains and losses wash into your P&L, your profit and loss statement. That's one. The other one is available for sale because you don't know whether you're going to sell them as a result of, some shortfall in your cash and you want to readily sell them off and, to meet your cash budget. And the last one is held to maturity, which you are required to make that election irrevocably. That means once you elect to hold to maturity, you have to make sure that you have the intent, one, and you have the ability to hold those investments to maturity. So if they are 5-year treasuries or 10-year treasuries, so because you are in a jam to raise cash, you can't sell them because that would taint the portfolio and you will never be ever allowed again to use that classification. And it's a safe classification when you have a reliable, when you want to make a very good long-term investment. So here's what happened to them. I understood, and I tried to look that up in the balance sheet, that they had about 55 billion, and I hope I'm right, in fixed income securities classified as held to maturity. So they could sell anything that wasn't available for sale, realize the loss. So I am projecting that had they been able to liquidate what was in their held to maturity portfolio, they would have been able to meet their cash shortfall, okay, without triggering all this panic. But because they had these much, up to 55 billion in that particular category, which by accounting rules, you cannot all of a sudden decide to sell them off. I think that contributed to, one of their problems. So overall, just to answer your question, I think when a company's treasury moves away from helping the entity stand financially, make all the sane financial decisions, and they try to become a profit center, they become more aggressive, right? And they chase profits wherever it goes. I think that also played a part in what happened to Silicon Valley Bank.
So if I'm understanding it correctly from what you're saying, right? They migrated from a daily, it's like a more of an accounting function of every day checking the books just to keep things balanced, moved to a more aggressive revenue generating venture. And in certain assets they held it to mature. I wonder how long that maturity, when held to maturity, we're talking about? We're talking about, a year. We're talking about 2, 3, 4.
It will vary because the more you keep adding to that category, okay, any one that was initially 5 years eventually will be 1 year left to maturity, right? So you have 1 year, you have 2 years, you have 3 years, you have 4 years, 5 years, and so forth. So what I'm saying is, once it's in that classification, for you to be able to move it out of that classification, so move it into available for sale, so you can sell that security. If you're a public company, you probably have to get a pre-clearance from the SEC. It's a very bad thing. It's a very bad thing because that's one way that you can tell investors and regulators that you don't make good judgment about your investments. So once you put some fixed income assets in held to maturity, rarely would you see any company that wants to reclass it out. So when I was, head of accounting policy in some French banks, right? 2 French banks, one BNP Paribas, the other one Crédit Agricole. For you, it could be a transaction being made here in the United States or out there in Brazil or somewhere in Australia. For you to be able to classify a fixed income security as held to maturity, you're going to have to get approval all the way from the Global Treasury Department because they monitor it. They don't want to put themselves in a jam where they put something there and they can't pull out when they need. So again, I think it's, the bad investment decisions made at SVB helped create the crisis that they suffered.
Interesting. Also, so the next question is, how do you feel that, with that collapse, how did it affect the wider banking industry in the region and so forth? Because we saw some other banks, and I think they call that contagion. Other banks now got impacted, right? Signature was impacted and so forth.
Well, there are a lot of other banks, regional banks, that are in the same category by size and by, being specific in catering to a certain industry that are just like Silicon Valley Bank, right? So, and investors, they get updates every day. Everyone knows what's going on. You look at your cell phone, you see, oh, this is happening to this bank. Very likely it could happen to the other bank. So they panic right there. Created, some sort of problem. People are, very easily they become skeptical of the banking system, given what they suffered in 2008 and the years prior, where, a lot of people lost their investments. So that sort of impact is what affected, or rather, what made the crisis worse than it should have been. Okay, it could have been just maybe one bank, albeit they had assets over 200 billion. But it's not enough to create the kind of crisis that we had in 2008. So I would say it's just that panic and the negative investor and depositor reaction. I think that's, the most damning consequence that it had. It could have been worse, but, the government stepped in and did something to stop it.
Yes, let's talk about that. Government stepping in. I mean, we see it in the news, depositors that were FDIC insured for under 250, they were safe. But in the terms of SVP, they worked with a lot of startups and a lot of VC firms. So it was millions there, payroll firms and so forth. So in this case, over the news, when the government stepped in, that weekend was crazy. I talked to some contacts that I have in the law side, and they have clients that were calling them. But the government stepped in and said, okay, we're going to, everyone should be made whole. Can you explain that process, please?
Okay, so prior to Dodd-Frank Act signed into law in 2010, if you had deposits in banks up to 150,000 there is a Federal Deposit Insurance Corporation, an independent agency created by Congress to insure those deposits, meaning that if anything went wrong with the bank and they go out of business, you will get at least $150,000 of your deposit back. In 2010, with Dodd-Frank Act, they moved it from 150 to 250. Okay, so at Silicon Valley Bank, just as were reported, a lot of their investors had, I think about 80% of all deposits were uninsured. And what did that mean? That means that individual investors had deposited with the bank more than the 250K limit that is insured. Okay? So when you have that sort of situation, you wonder, why would somebody, let's say somebody has $1 million. Why would you put all of your million in one bank when you know only 250,000 will be insured? But there's a number of reasons why that could happen. You are enticed, okay, into leaving your deposit. Your deposit to you is an investment, and you want to go where there are higher returns. So, and higher returns imply higher risks, okay? So if I take my 1 million and put there, it's because they probably, other than regular checking account and savings account, they probably also offered them structured deposit. What is a structured deposit? A structured deposit is this deposit where I will put $1 million in a bank, and they tell me, we can pay you, interest then was, 0.5% per annum, right? Back in the beginning of 2022. But they can tell me, in lieu of interest, we can index your income, okay, on the movement of the S&P or on the Dow Jones index or any other index. It could be a startup. Oh, we have these startups, Silicon Valley startups, that you know how they do well. Once they come out, instead, in lieu of getting interest income, we can have you participate somehow through a certificate or whatever it is in the equity performance of those entities. It will give you a higher return. It works sometimes. It makes people millionaires. They realize a lot of income, but it comes with a big risk. So when something is wrong with that industry and the expectation was, like way beyond what reality is, so then that also helps create panic. So what am I trying to say? I'm trying to say that other than the fact that, okay, Silicon Valley Bank made a loan to me as a customer and requires me to, in lieu of, having 1 percentage point or fractional basis points lower than the going rate, they say, as long as you leave your deposit with us up to this much, you get the lower rate. So people have a number of ways that they get enticed into leaving their money there. So one of the things the government said is, okay, whether you were insured or not insured, as long as you had a deposit with SVB or Signature Bank, the government would take care of it. And right there, you heard the president when he said, the taxpayer will not be responsible for it. So then where will the money come to make the depositors whole? The FDIC, the banks contribute money to the FDIC to insure deposits. So if one bank fails to the extent that they had deposits that were insured, they would take money from there to make depositors whole. So I think, could be wrong, I think that there's a lot of money there and no banks are failing, so they can dip hand into that money and make these people whole. And then gradually resolve. Okay, when they investigate, they're still investigating what happened at SVB, where somebody is going to have to be responsible for it. But these are temporary measures to make sure that whatever went wrong at SVP does not cascade to a lot of other banks and affect the banking system. So I hope I answered that question. If I didn't, I can explain it in a different way.
No, you did. what I want to show people, because this is something that kind of in researching this show, I found interesting, the number of bank failures over the last 2 decades. And once we look at that and go through it, for my podcast people, you're not going to be able to see it, so I'm going to talk through some of them. And for everyone else, I'm just going to put it on the screen right now. After we go through this, I want to talk to you about warning signs. I want to talk to you about what are ways to prevent bank failures, and we can just go through those litany of questions. But let's let me go to the screen right now, because I don't think people realize this. I mean, because everything happens. I mean, once we start talking about it, it's in the news 24/7. People realize, but over the last few years, I mean, obviously now in March we had the two major ones: Signature Bank, Silicon Valley Bank, right?
Yeah.
Then they were subsequently acquired by other firms. Signature, Flagstar Bank stepped in to acquire them. It looks like First Citizens Bank of Trust Company is going to acquire Silicon Valley. But if we look at 2020, we have Almena State Bank failed. First City Bank of Florida in October 2020 failed. Going to 2017, I mean, it's just a list. All every year, it's like, well, I don't see 2021, but 2019, we have Resolute Bank. We have Louisiana Community Bank. Going down even further, let's go. I'm just going to go high level throughout the last 20 years. Allied Bank in Mulberry, September 2016. Hometown National Bank in Longview failed, October 2nd, 2015. These are the things that, wasn't really pumping in the news the way SVB is. Looking at 2014, National Republic Bank of Chicago, Green Choice Bank of Chicago, Freedom State Bank, Freedom, Oklahoma, 2014, Valley Bank in Illinois, 2014. Let's keep going. Let's go down the list. It's very interesting stuff here. 2009, right? We know 2009. It was like every single month, different banks. But we didn't.
That was the 2008 credit crisis that wiped out a lot of banking organizations like and non-banking organizations.
Yeah, United Commercial, Gateway, Prosperin, United Security Bank. Some of these banks, Citizen National Bank of Texas, U.S. Bank in 2008, obviously. Washington Mutual, talked about that in the show notes. Integrity Bank, Columbian Bank. It's just tons of bank failures, right? Then we go even before that to 2000 to 2000. Bank of Honolulu in 2000, 2001. Obviously, that was a hit. 9/11 or around that time. Sinclair National Bank in Arizona, Superior in 2002, Universal Federal. So the point that I'm making when bringing this up is bank failures are not necessarily a new phenomenon, right? We see over the last 2 decades tons and tons of bank fail. Obviously, in certain errors, right? So you have 2008 major error. We have now 2023, another highlight that's going to be historical major error. But in between those times, many banks fail. So the question I have, what are some of the warning signs?
What is what?
What are some of the warning signs prior to a failure? Like,
okay,
why isn't this anticipated?
Let me first say that banks fail, okay? Regardless of whatever kind of regulatory standards that you put in place, banks will always fail, just like any business will fail. If you go and download all the businesses that have filed for bankruptcy in the last year, it will actually outnumber all the banks that you have here. So a bank as a business, okay, they are in it to make money. When they are not making money over a sustained period of time, they will fold, okay? So the reason you haven't been hearing these ones that happened a couple of years ago, several years ago, after Dodd-Frank is in place, is because they are not, how do they say it, systemically important to the financial system, the financial industry. Sci-fi, Dodd-Frank called it. So SVB and Signature, they are SIFIs, SIFI for short. That's what it's called. But because of lobbying, okay, let me just put it this way. When Dodd-Frank was put in place, they stated that every bank that has 50 billion and more in total assets is a SIFI. And what does SIFI mean? That means they will be subject to the enhanced prudential standards that Dodd-Frank Act, laid out. In addition to that, that they require regular and more stringent regulatory supervision. Okay? So in 2018, some smart Congress people, Republicans and Democrats alike, were lobbied, and the chief lobbyist was the CEO of SVB, okay, Silicon Valley Bank, and told them that on their own, they being regional banks, they don't meet the standard to be systemically important to the financial industry. And the lobby worked. So they said, okay, let's move it from 250 billion to 250 billion. So all the enhanced prudential standards requirements got dropped. They were no longer applying them. Okay. You will ask, could the government have done anything to prevent what happened to SVB? Yes. If you didn't, relax the rules, they wouldn't have gone through what they went through. So this is, what happened. I also want to mention, when you listed all, several banks that failed or went out of business, some of them were regional or community banks, right? Some of them were only sustained because there was a giant, a couple of factories in some rural place, and all the employees that lived around and everybody, kind of supported the bank. But when that factory shut down or anything like that happens, they don't have enough customers to sustain the bank. So they, eventually they fold and kind of go away. So warning signs, I would say, when the head of or the board of your bank begins to spend a lot of money in lobbying, there is always something they lobby for, almost always, is to relax the rules, to give them the freedom to take more risks. That's what it is. Okay, that's the number one sign. When your bank starts to, for instance, when they say, do not have any uncovered derivative instruments, but they do. They begin to be very active. Their treasury begins to be very active in issuing instruments, trading. That's your number one warning sign. But the ordinary individual will not know what's going on. So only people who can pull down their financial statements, look at the balance sheet, see what kind of assets they have, classifications and all of that, can say, I think these people are, going the wrong way. Okay. There are banks the large banks that no matter what happens, it will be difficult for them to fail. And I will tell you, a bank like JP Morgan, okay, I don't think such a bank can fail, because I tell you why, and there's a host of them. There are some of them that apply more of the requirements. They exceed the minimum requirement that they needed to remain stable, even under strenuous financial conditions. So they go above and beyond. I can name another, my former employer, American Express. If the Fed say you must have 10%, okay, tier one equity, they will have 14 or 15. Okay, this is just okay.
That's interesting that you said that. So we would consider American Express a bank?
American Express became a bank as a result of the 2008 credit crisis. The US government decided that American Express, one of them, Goldman Sachs, one of them, they are now banks. And also GE Capital then became a bank, okay? And they spun it off as a Synchrony Bank, right? So if you hear about Synchrony, it started from so they said, in order to, because those companies were financially strong and were not shaken by the crisis, just like Lehman went by the wayside. AIG, were it not for free money from the government, they would have been done. But there were some companies that withstood all that shock. Do you know why? Because they were already applying some of these strict prudential standards by themselves. Not that they were required, because they know that they needed it to survive. You get what I'm saying?
It's a lot to I want to unpack quite a few things that you said. So I'm learning while talking to you during this live. Number one is that sci-fi attribute that or categorization that they put on certain banks.
Yes.
From the FDIC. So, 2018, you said. Prior to that, 50 billion was the cutoff. If you had more than 50 billion in assets, you were considered a sci-fi. Therefore, enhanced regulatory rules are applied, and that goes back to the Dodd-Frank Act of 2010. Do I have that correct?
Yes.
Okay. So 2018 happens.
Yes.
Huge lobbying going on by SVB.
Yes.
To increase that threshold from 50 to 250. So now if it's 250, they're not considered a sci-fi anymore. They don't have to go through extra stringent standards.
Exactly.
Now, when we start talking about 250 and above, we know the big players. We know Citi. We know JP Morgan. We know all those major banks. They have well over 250. Some even in the
they have trillions in balance sheet.
Trillions in this asset.
So just for history's sake, after that amendment in 2018, okay, there were only 12 sci-fis left in the United States, and that should have been a warning sign. We had a senator, you know her, Elizabeth Warren. She was screaming. She said, "You people don't know what you are doing. You will see the outcome in the next few. Some banks are going to fail." And so when SVP crisis was announced, she came out and she said, "Didn't I tell you this was going to happen?"
Let's unpack that. So 2018 happens. Before 2018, do you know the number of sci-fis that were? Do we have that information or no? I'm curious.
It was in hundreds.
Hundreds.
Yes, it was in hundreds.
That meant
it was in hundreds, including U.S. branches of foreign banking organizations.
Okay.
Because they too were subjected to the enhanced prudential standard.
Give me an example. Give me an example of a foreign bank.
BNP Paribas. Okay, I'll tell you. I was actually part of the work stream when they were implementing the Dodd-Frank Act. And what he said to them was, yes, your US branch alone doing only banking falls below the 50 billion. But you have other non-banking subsidiaries in the United States that you used to do a lot of things. You issue commercialized loan obligations, you do commercial paper, you do all of that. You say, as part of Dodd-Frank, banks like that were required to consolidate all of those subsidiaries and put them together. And if you put them together and they meet the 50 billion asset test, then you have to treat them as sci-fis. And that's what happened. So this bank, okay, had to consolidate 43 entities into one consolidated intermediate holding company. And that's where the feds came to regulate, just like they will regulate Citibank and JP Morgan. You understand what I'm saying?
Steph, I want to throw something in, right?
Yeah.
Recently, we see Credit Suisse got, it didn't work out for them. They collapsed, right?
Mm-hmm.
Were they considered a sci-fi?
No, I don't think they were. So what happened was, once Dodd-Frank implementation, I think every foreign banking organization had until July 1st, 2016 to meet the consolidation requirement. So what some foreign banking organizations did was they wound down their activities in the United States so that they would stay below. Okay? So they will fall below the 50 billion cutoff. And that is so they don't have to implement the Dodd-Frank Act enhanced prudential standards, okay, applicable to all large banks. So then, but some like the BNP Paribas remained, I think they had about, could have been about 109 billion in assets in the United States. So almost before, oh no, not, okay, say 1 year or so after the implementation, that would be around 2017 or so. However, in 2015, 2016, there have been a lot of lawmakers, like complaining that the requirements are too heavy, that banks it's too expensive, they cannot do it, the threshold is too low, it should be brought up. So, and then we used to have strategy sessions. And there was a question that the senior management of BNPP was, I say, now that there is a possibility that they will increase this from 50 to 250, and you are at 109. What are you going to do? Stop all this project and all of that? And the CEO said, we actually found that the prudential standards requirement is good for banking and that every bank needs it. So we're going to go ahead and continue to use it. Even if they say it's not required in the United States, we're going to be doing it because it's good for our banking strategy. So there are banking leadership like that. And there are those that want to do the bare minimum or even try to avoid doing that at all. They are the risk takers.
Question for you on that. I mean, it's so much to unpack, but I'm gonna jump back into something you previously said, and I'm gonna ask a follow-up question.
Yes.
What you previously said was, because you got a lot of people that are paranoid. I mean, there's a segment of society that's literally paranoid about banks. I mean, but it is like but some people might not understand the 250 FDIC insurance policy there, and they have under 250, but they're still paranoid. But in general now, you mentioned something interesting. You said, when we start looking at warning signs, now let's say that you're a startup, you have millions of dollars that you're gonna deposit and so forth, but you want to make sure that it would be prudent to diversify, obviously, different banking relationships. I'm a believer in that. But let's say now you want to make sure that the bank that you are banking with is pretty stable. You mentioned looking at their financial statements.
Yes.
It seems like an opportunity there, right? An opportunity, even if you say, you know what, because this financial statement is public information. I would assume,
it is public, right? For all public companies, right. Yes.
So is it then advisable? I mean, most will have a CFO involved, or even maybe bringing in that outside entity to get an opinion on, listen, I'm going to establish this banking relationship. Can you review their financial statements, making sure that this is a pretty stable bet? Like, what are your thoughts about? Because I don't know if that's an actual practice that a lot of startups do.
Okay, well, that's what investment advisors do. That's their job, right? They will recommend you. They tell you they want to know your income, what you have, your assets, and they make recommendations and actually tell you which banks to stay away from. So there are people whose is their jobs. But if you have a little bit of financial knowledge, pick up the financial statements. You can forget the tables, okay? The tables, only financial analysts and accountants understand, can make something out of the balance sheet, the income statement, and all of that. But go to the footnote disclosures, because they are required to describe every risk they are taking, what is standard in the industry, and when they go outside of the industry, all of those are in the footnotes. So, but some people don't read the footnotes to the financial statements. That's where all the information is. So if you really want to know management style, their risk appetite and all of that stuff, you can pick that out from the disclosures that they are required to make. If they don't make the disclosures, their auditors won't sign off on the financial statement.
Wow. And another question I have for you then, you're a startup, right? Mm-hmm. You just got funded, your Series A or your B, you have a few million now. You need to put it somewhere for payroll and stuff like that. Why wouldn't you go to a sci-fi, right? As opposed to a smaller bank that doesn't have as strict requirements and so forth.
Prior to Silicon Valley Bank demise, you could, as a startup, submit the same loan application, similar loan application, okay, to SVB and also to JP Morgan. JP Morgan will turn you down, but SVB will approve. And in return, they want you to leave your money with them. And a lot of people, want to show, like some, being loyal to people that help you. So you leave your money there. That's one of the reasons.
Look, we have so many questions. Let me, a LinkedIn comment came in. The footnotes are juicy sources of information. If you're a LinkedIn user, I'd like to address you by name. You could post your name. That'd be greatly appreciated. But thank you for your comment. Really appreciate it. That's good information. I'm going to take that and run with it myself. Now you have to be a friend of the show, and we have to have you on more, because I feel like we could talk about these types of things and other subjects for hours. And I know I want to be respectful for your time. But before, because I know we're getting towards that ending time, this term bank stress test, can you describe what that is?
Well, it is a test that all banks are required to do. And, you do some kind of modeling using different economic conditions to see whether under adverse conditions, whether you can sustain it and survive beyond, that catastrophe. So all banks are required to do it. But the sci-fis, like I said, their own stress test is more strict as a result of the requirements in the Dodd-Frank Act. And they consider everything. There are a lot of risks that every banking organization faces: legal risk, reputational risk, operational risk, liquidity risk, market risk, interest risk. So all of them plus more are put in and modeled into this test just to see whether they will have issues under certain conditions. And if they will have issues, they have to start taking corrective actions and work with whoever is assigned to them at the regulators that will walk them through it. So that's pretty much what this test represents.
Who conducts the test?
Say that again.
Who performs the test? Is it an external?
Okay, well, you have to have your team. Okay, within every bank, you have your CCAR team, and you have risk team. You have every team, and they work together. So these tests are actually conducted by the banks and documented by the banks and submitted for review by the regulators.
Got it.
Yeah.
Got it. All right. No, this is interesting stuff. So a LinkedIn comment came in from the same, especially the independent auditor statement on financial condition. I guess they were referring to the financial statements, and they're saying that that can be extremely useful as well.
Well, okay. So sometimes if that's your primary source, it could come late. From what I understand, the auditors of SVP saw nothing wrong until, they had their year end is December 31st, 2022. Okay, and they got a clean audit opinion. And then subsequent to that, they are in trouble. So I'm saying you could look in that financial statement, go to the notes in the financial statement and see there may be something glaring right there, but which, the auditors overlooked.
It's so much to unpack. Like I said, I think we're going to definitely have you on right now as one of our friends of the show. When these things happen, we want to jump insight, bring you back on to talk. Really appreciate you coming on today. I would speak for the audience. I know myself, I learned, even though I'm in the financial side of things, I've been so for years on the technology side. And, I've been in institutions where we had to make technology changes to support Dodd-Frank and things of that nature. But getting this business insight from you, especially on the sci-fi side in 2018, extremely informative. things that now, I'm learning. I'm like, wow, okay, I didn't know that. Last question that I have, actually, before we head off, because I was thinking about this and I didn't bring it up. Do you think that sci-fi category of 250 is going to be reduced due to pure speculation, due to what happened to SVB? Like, do you think that threshold is going to go back to 50 million or 100 or below? What are your thoughts there?
Okay. So based on what I know so far, a couple of Democrats, especially the ones that voted for the easing of that requirement with Republicans, they are all on board to bring it down. But they have opposition from their Republican counterparts. I think somehow, it's politics, right? Depends on who is in Congress. Because the government stepped in, and because the president says it will not be borne by the taxpayers, I think this will quietly go away and everybody forgets it. But if more banks, like somebody predicted that this is only the beginning. So if it begins to happen again, I think that a lot of people will be alarmed and want to do something by bringing it back to what it was at 50 billion in total assets.
Wow. Really, really amazing stuff. Listen, you're the CEO of Accounting Events. Please let everyone know how to find you and follow up if they have further questions or maybe other, because we target a lot of startup communities and different viewers. So how can they find you if they want more information and so forth?
I'm on LinkedIn as Stanley Egbuchulam. You can find me there. And my business has a website, www.accountingevents.com. And if you have any questions, even related to what we talked about, you can go there, fill out the form, and I will respond to you. My phone number is there too. You can give me a call.
What I'm going to do is I'm going to your website right now. I'm going to put it in the comments so that I'm going to put it as part of the show, so it can be part of the video forever. Content lives forever. So
yeah, exactly.
Give me a second. I'll do that right now. Okay. It's Accounting Events is officially part of this video that's going to last forever.
Thank you.
If you want to find Stanley Egbuchulam at Accounting Events. Listen, thank you so much for being a guest today. Really appreciate it. Really appreciate the insight. You're now officially, you can't say no. You're a friend of the show. So when these things happen, I'm going to bring you back on. I'm going to get some insight and then ask the questions that we can all learn from.
Okay, that's wonderful.
You enjoy the rest of your day and have a marvelous weekend.
Have a nice weekend.
To people watching the show. So every week, 12 p.m. Tech Behind FinTech. Next month is April. It's going to be our SOC 2 month. We're going to cover everything around SOC 2. We're going to have some SOC 2 auditors there. We're going to talk about SOC 2 continuous monitoring automation. We're going to talk about pen testing effort at the end. It's going to be an amazing month covering SOC 2. This show was sponsored by Strategic Generation, offering SOC 2 services and penetration testing services in terms of cybersecurity. Once again, thank you very much for your time. Tune in every Friday, 12 p.m. Eastern Standard Time, live for the Tech Behind FinTech. All right, guys. Cheers.
Thank you.
Thank you.
Understanding the technology that powers the money is essential. Knowing the business drivers that inspire how the money is made is crucial. Bridging the gap between the mind of the technologist and the mind of the business is monumental. That is what TBF is all about. Let's start this never-ending conversation. It's time.